So somebody just got a $20,000 earnest money request on an offer for a wholesale deal on a unit that's going to cost around $500,000. And the first instinct was this feels a little off. But I'm going to explain why not only is it not off, sometimes it can be normal, and sometimes it could be the biggest red flag of the entire real estate transaction. Let's talk about it. First, I want to show everybody this screenshot. So this screenshot says, somebody sent me a deal today with the $20,000 earnest money deposit requirement. Is anyone else in the market seeing $20 EMD requirements for a 500K wholesale deal? It's a little red flag to me personally, but I'm wondering if anyone else sees this is standard in their market. And then somebody else said, EMD can be 100K on a 200K purchase. Every deal is different. True. We got a deal that had a lot of EMD like that too. Okay. Yes, I'm writing a loan on a 6-unit multifamily in Chicago that required 20K EMD. Happy to connect and learn more. So the reason that I bring up that screenshot, I think you all should look at it, read it, is because the responses are split on there. Some people say it is normal, some people say it's not, some people say they've seen higher, some people say they've seen lower. But what they're answering is based on a number. And I want to pitch to you all that in Illinois, it's a bit different than when I was in Texas. It's less about the number in Illinois and more about the structure. Because if you plan to commit to the deal, you shouldn't be worried about your whatever amount the EMB is. Because the truth is you're going to be paying that eventually. So just fork it over, let them know you're committed, yada, yada, yada. That we got all that. But what earnest money is not just a deposit. It is a risk management tool for the sellers. So when somebody backs out of a deal, they don't leave the deal empty-handed. And in some cases, that can be a critical point for the seller. The simplest way to understand it is when you're putting up earnest money, you're telling the seller, hey, portion of my risk is coming on from you to me. So you can calm down because I'm going to purchase this property. I promise. So on 500K of typical earnest money between 1 and 5%, you could see a real easy 5K, 10K, 15K earnest money deposit. So yeah, 20K is a little bit high, but is it abnormal? It's not completely abnormal. What it probably is a seller that just wants to make sure that whatever happens, the deal on the table will actually close eventually. So if you don't think that you can close, you probably just shouldn't use that deal as your main revenue engine, if that makes sense. And then the other thing that people in real estate don't tell you that is not just the math. So with real estate, a lot of these transactions is all about the structure and how you structure the deal and what you include and don't include in the contracts. This can be a very critical thing that a lot of people don't really understand, but we'll get into it. Because I need to slow this down because a lot of people get different markets confused. And I'm somebody that I actually started my career out in Dallas, Fort Worth at DFW Metroplex. And it's a little bit different than the Chicagoland area. I will say that for sure. It's just different in the aspect of Chicago is more strict, but also less strict. I don't know how to say it. It feels like Texas kind of had everything built out for investors. Chicago has everything built out for homeowners. So it's a little bit of a different program. But in Texas, the due diligence is built into the very first stages of the transaction. Out here in Illinois, you kind of have to negotiate around it and see where you can get your foot in the door. In Texas, you have your option period and it's kind of unavoidable. And if you don't want an option, you're waiving practically everything. You're waiving your inspection, you're waiving everything. You're basically coming to the transaction cash and trusting that whatever they tell you is true. and hoping that you don't find out that the foundation sucks and everything. Like, it's a hope and a prayer out there. Out here, there's a little more structure, but you also have to negotiate that structure. Because if you don't negotiate the structure, you're just going to be the one that loses the ball. You're going to be the one that loses the money to the seller because you didn't structure the deal to be centered around your financing contingency, or you didn't structure the deal to be centered around your appraisal, or you didn't structure the deal to be centered around inspection. So certain things came up, and it came up after you've already lost your money. There's not much you can do about that. The seller gets the money. But if you know how to negotiate, you know how to tell your agent, hey, I'm willing to commit to this deal. I'll put whatever they need on it. But I need to know that if this and this happens, I'm protected. Because as long as you talk to your agent about it, you'll be fine. And if you don't have an agent, you need to be using ChatGPT or Cloud or Google Gemini to figure out how you can write your contracts. If you're a FSBO, write your contracts and negotiate your contracts in a way that actually benefits you. A lot of people don't talk about that, but you have to be benefiting you. Because in Texas, you got a lot of standardized TREC contracts. You have a defined option period. You got clear delivery timelines, a very clear understanding of when earnest money becomes at risk. So what happens is in Texas, you might put up $10,000, $15,000, $20,000, but during that option period, typically 5 or 10 days, you can walk away completely, and the worst that you would lose is your option fee, not your full earnest money deposit. That's a huge difference. Out here in Illinois, it's not like that. The risk isn't live immediately in Texas. It is in Chicago. In Chicago and really Illinois in general, it just does not operate like that. Out here, everything is more negotiable, which at first glance sounds good, but you have to realize that protection is negotiable too. So if you're not negotiating from your strongest standpoint, you're going to drop the ball. You have to negotiate these things for yourself. Because in Chicago, earnest money can be held by the title company, it can be held by the brokerage trust account from the buyer or the seller, or it can be held by the attorney in escrow. And that all matters more than people think, because different agencies, different brokerages, different attorneys, different title companies have different rules, policies, and regulations on how they will disperse the earnest money in the case of this event or that event, or what happens if the contract doesn't fail, or what happens if it's not executed, what happens if the seller doesn't perform, if the buyer doesn't perform. You have to get all that in writing from the very beginning. So let's break each one down. Let's break down the different segments and the different groups of who can hold your earnest money in Illinois. And I'm not going to give you a recommendation on who you should hold your earnest money with, but I'm going to let you know that some of these people have different intents and motives to holding your money than others do. So you have to decide what is in the best benefit for you. If you're a seller watching this video, it might be one thing. If you're a buyer watching this video, it might be another thing. If you're a managing broker watching this video, it might be another thing. So that's why I'm not taking a stance. Just watch and listen. Just smile and wave, boys. Smile and wave. So when the title company holds the earnest money, they act as a neutral third party. They release funds based on contract terms, and they're not emotionally tied to the deal closing. Typically, if there's a dispute, they don't pick a side. They follow the instructions written down in the agreement signed by both parties. You want that. Now, there is an important nuance here. Not all title companies want to hold earnest money, especially in wholesale deals, and some will decline it and deny it from the very beginning. So just because a title isn't holding it doesn't mean it's automatically a bad deal, but it does mean you need to pay closer attention. So when the brokerage holds the earnest money account, buyer or seller brokerage, it doesn't matter. It goes into a regulated trust account. There are compliance rules, but that brokerage is also tied to the transaction closing. So now you have someone holding your money, whether you are the buyer or the seller, it doesn't matter. And that doesn't mean it's wrong, but you have to look at it from an outside perspective. It's not a neutral arbiter of truth. So if you are going to go that direction, you might want to choose somebody that's on your side. That's all I'm going to say about that. When the attorney holds it, okay. Oh, sorry, the camera had cut off, child. So when the attorney holds the earnest money deposit, it can be very structured, especially in Illinois, where attorneys typically are pretty involved unless you're kind of out far from Chicago. But again, it depends on who the attorney represents, because now you're dealing with legal interpretation of the contract if things go left. So I want to go back up to the title company. I don't think that any of these parties are truthfully neutral arbiters, because somebody has to bring the title company to the table. But I think that if you're getting the most neutral representation or the neutral arbiter of who's holding your earnest money, it would be the title company. They're just going to follow whatever the contract says. Typically, all parties are going to follow what the contract says, but you just have to remember that the buyer's brokerage or the seller's brokerage, if they're holding the earnest money, they have an incentive or a motive to hold or keep your money. You're like, well, that's not ethical. Just because it's not ethical, do you want to sit in court fighting for your money? No, just put on the contract, hold it with the title company so you make sure you get your money back as the contract says. Or keep it with the attorney. Keep it with the brokerage. Keep it with the brokerage and make sure it's your brokerage, so at least you know you're getting your money. Just do something that benefits you. It be the buyer or the seller. Do benefit you. So now we all understand this very important point. The risk isn't just how much you're putting up. It don't matter if it's $5K, $20K, if it don't matter if it's $500 or $5,000 or $50,000 or $500,000. It's who controls things when things go wrong. So if you need to get out of your contract, who has your money? That's what you need to be thinking about. So now we have to layer the whole wholesale component into this, because that's where another layer gets into the grittiness of it all. In a traditional deal, you buy the property, period, outright, whether it's cash, finance. In a wholesale deal, you are buying someone else's equity in the contract to buy the property. So they're assigning you their right to buy the property because they already locked it up. It's a completely different level of risk. In Illinois, most title companies won't even take it on if you're not licensed, because you cannot wholesale without a license. You can do one a year, but that's a whole different conversation. That means you might not have full access to the property. You might be relying on someone else's numbers. You might not control the timeline. And most importantly, your earnest money will be at risk from the second you turn it in, because you don't have full control over the outcome, especially if you don't already have a buyer. But even if you already have a buyer, anything can happen and you could be the one with the ball, stuck holding the ball. Do you want that? So now that $20,000 is not just a deposit, that's the potential cost of being wrong. And here's where I would start personally asking questions. Where is the earnest money actually being held? When does it become non-refundable? Do I have a real inspection window or just a walkthrough? Are the numbers independently verified? Am I able to perform my own due diligence? And who actually controls the contract and the money, which typically you have to negotiate those terms. So be smart about that. And then here's what experienced investors understand. Wholesalers do not just use a high earnest money to show strength. They use it to transfer risk downstream, meaning if the deal falls apart, they're protected and you're not. So you gotta watch for that. Now, to be clear, this doesn't mean that holding high earnest money is bad or low earnest money is cheap. But in competitive deals, especially in multifamily deals in Chicago, $20K EMD is completely normal and not out of the range. But in those situations, if the deal is tight, the numbers are real, and the structure is clean, those different variables can be all the determining factor. So the real takeaway is this: earnest money isn't risky inherently, but it's the structure around it. Are you willing to negotiate a deal for yourself or for your client that benefits you